This is a pretty phenomenal chart, Ben. It shows just how interested foreigners still are.
Yep.
Is it because they have to be? I mean, we were looking earlier in the week at how real yields in the US are negative.
Yep. So several factors are driving that hunt for yield. One obviously is the fact that in the world we're living in, the U.S. bond yield is actually a pretty decent yield, right? Even though it's low in absolute terms, and so you have a lot of interest by search for yield from foreign buyers. Another factor that's driving that is the fact that pretty much ubiquitously, we're going through a period where monetary policy has been very easy in developed markets. That's across the board. So if you're just to look at all central banks across developed markets, 70% of them have eased this year, have cut rates. Of course, the one that hasn't is the Fed, where we were expecting a rate hike. So everyone's kind of moving in the same direction. All of that keeps yields relatively low.
But what's so fascinating about this, and yes, it looks like there's a difference between, US yields and the yields in the rest of the world, but
Yep.
if you have to hedge for currency exchanges, then it's not so attractive.
Yeah, I think the FX component is one, depending on your perspective. I think another factor that we think about a lot as providing some upside risk to U.S. bond yields is the fact that U.S. inflation has actually come back. This idea that U.S. inflation is low and is always going to be low is an anachronism at this point, right? You have core CPI inflation that's above 2%. Core PCE inflation, the Fed's preferred, is 1.6 and rising. You have wage measures, which on average have been going up, and a tightening labor market, which is going to continue that trend. So I think the U.S. yields are a balancing act, right? You have foreign demand, monetary policy pushing them down, but you have stable U.S. growth, if not gangbusters, plus recovering inflation pushing in the opposite direction. So I actually see two-way risk when you think about U.S. Treasuries.
Ben, talking about this hunt for yield, I want to show you a chart on my Bloomberg, which is the Barclays high yield spread, showing the average OAS is at its tightest in a year. In other words, the spread between high yield and benchmark bonds, that coming down. So bearing this in mind, is actually going after high yield worth the risk?
In our view, we think it is. In this low growth world, choosing where you express your attitude towards risk is a more nuanced endeavor, right? It's not as if we're in a world where growth is so high that all risk assets outperform, and so you have to choose what part of the capital structure of firms you want to reside in. And so we like credit, in particular high yield credit, under reasonable assumptions. You're getting mid-single-digit returns this year, even at current valuations. And in the background there, we're assuming that overall default risk remains contained within the energy sector in particular. And these valuations don't seem overstretched to us, given that confluence of factors.
And, looking at the energy sector and therefore at oil as well, I want to sort of shift this to emerging markets, because I believe your view has changed a little. We had, of course, a strong rally over the past few days. It's come off a bit for emerging market assets today. This is a nuanced conversation when we look at EM. What are you looking at that's changing your view here?
Yeah, I think you look at the big facilitating factors, the big risks to the global economy. And of course, at the center of that in the past year has been China. And so China is an area where you've seen some stabilization on the macro front. People are no longer running to the exits in terms of capital flight from China. FX reserves have been pretty stable. So I think that kind of anchors a view, or at very least removes some downside risk from that. And then across the EM complex, you've seen a little bit of improvement. And so I think we're a bit ambivalent in that sense, right? You have some improvement, some stabilization, but not enough that we'd be willing to overlook sort of the fundamental factors and the persistent drags on emerging market economies. And so it's the type of thing where when the tide recedes, you'll see who's been swimming naked. And in this case, we like the higher quality markets like the U.S. versus emerging markets.